Hello, welcome to the Wealthy Wallet Podcast, your go-to source for tax strategies. I am your host, Monika Hengesbach. I'm an enrolled agent with Decision Financial Services, and today we're going to dive into the world of real estate tax planning. So whether you are a seasoned real estate investor or just someone that is just starting out, this episode is going to definitely help you, give you the tools to gather valuable insight to help you save money on your real estate investments. So the first thing that I want to talk to you is just break down some of the tax topics that we have, and it's going to start with real estate taxes. I'm going to talk a little bit about how property taxes are assessed. So basically how they're assessed is they're levied based upon your appraised value. And that can actually vary widely depending on where your property is located. It's very important to know how your property taxes are calculated because that's actually going to impact your overall investment. For example, if you go into a very high taxed area and you're paying rather high property taxes, but you're not going to get the rent for that, is that really a smart investment in the long run? For example, let's take a fair market value home of $750,000, and if you're in the Colleyville Grapevine ISD school district, you're going to be paying $14,655 annually on the property taxes. But if you're in the Keller ISD district, you're going to be paying $15,878 annually. That's a big bite. But there are ways to save money on your property taxes. And one of them is, if this is your primary residence, please homestead it. In Tarrant County, the average homestead exemption is $10,000. And the other way of doing it, which I highly recommend, even if it's your primary residence, even if we still get the homestead exemption, you don't qualify for the homestead exemption on your investment property. Challenge your property appraisals, because in the state of Texas, property values are assessed based upon the fair market value starting January 1st. And the way they get the fair market value is what properties were selling for in your neighborhood. So let's say you bought a fixer-upper, for example. Well, the house next door to you sold for $500,000, but because your property in the condition that it is in is only valued at $250,000. The appraisal district is going to value your property at $500,000 because that's what is the neighborhood's going rate. You want to fight that. You want to bring proof as to why you believe your property taxes are lower and save some money as you're trying to rehab your property and get it ready for investing. The other thing that we need to talk about is capital gains tax. This is always the one that really takes a bite out of our investments. If you're selling an investment property for a profit, 99% of the time you're going to end up paying capital gains tax on the profit. The amount that you're going to pay really depends on how long you've owned the property and your tax bracket. So if you've owned the property short term, which is less than a year, that is actually taxed at your ordinary income tax rate. And that could be at the lowest tax bracket, which is 10%, up to the highest tax bracket of 37%. Your overall tax bracket is based upon all of your income sources, your W-2s, your interest income, dividends, any other business profit. So you can actually, if you sold your property short term, could be paying a very high capital gains tax. If you've owned it for greater than a year, so please don't think that I've owned it for 12 months and I'm going to sell it, because guess what? The IRS is going to rule that short term. You need it 12 months plus 1 day. Then you fall into the long-term bracket, and that's either going to be 15% or 20% depending on your bracket. My next slide shows the brackets and how it's calculated. And so, for example, there is a 0% capital gains tax rate, but if you're a single individual, that's up to about approximately $47,000, and if you're married filing jointly, it's up to $94,000. Here's the caveat. Let's say my overall income, I'm a married individual, my W-2s between me and my partner, they total about $75,000. one would think that the sale of my investment property would fall into a 0% capital gains tax. Because you have to add the gain in that number. And so again, if I have a W-2 combined roughly about 50,000 and I have a 50,000 capital gains tax, that has put my income to 100,000. I've just bumped up to the 15% capital gains tax rate. And then obviously, as you can see, the brackets are very large. You don't normally hit the 20% bracket until your taxable income is over $500,000. The other thing that one has to consider is depreciation. Now, depreciation it allows you to deduct the cost of your property over its useful life. We kind of know that, residential property, our life, they give us is 27 and a half years. Commercial, it's 39 years. And this is actually what puts a lot of my investment clients to show a loss is the depreciation. And they might be cash flowing, but on paper we're showing a loss because they bought the property for $500,000. They're depreciating over 27 and a half years. That expense goes against it and it lowers its profit. So for real estate investors, this can be actually a very substantial cost savings. Land is not depreciated. And so some of the errors that I find on tax returns on new clients that have come to me is that their previous accountants have combined the property. Because when you buy a piece of property on the settlement statement, it really doesn't break out, this is the cost of the building, this is the cost of the land. It just says you bought the property for X amount of dollars. It takes the accountant to go out and look up the appraisal district numbers to determine what the value of that land is. The reason why I'm stressing this point is as we go later, there is something called depreciation recapture. And depreciation recapture is what hurts a lot of my clients when they get ready to sell investment property, because they end up having to pay tax on all the depreciation that they've taken over the lifetime of owning the property. And that tax doesn't fall under that nice 15% or 20% bracket. It falls under your ordinary income tax brackets capped at 25%. So you're going to end up paying more tax on the depreciation recapture than you are in your capital gains tax. That's why it's very imperative that we just don't throw something in there that we don't really need to depreciate, because lo and behold, you're going to have to recapture it and pay higher money on taxes. Another thing about depreciation is something called bonus depreciation. In the past, we used to have this lovely thing where we were able to write off, if it fell in the proper category, 100% of our assets purchased or placed in service in the year of acquiring them. That law expired. And so now where it is in 2024 is that we're only able to write off 60% of the assets that were placed in service in 2024. However, currently in the works, it's called the Tax Relief for American Families and Workers Act of 2024. If passed, they will extend out that 100% bonus depreciation back to January 1st, 2026. This is really big for my real estate investors. And the reason why is when you hear me talk a little later in this podcast, I talk about something called cost segregation. Cost segregation is a huge tax planning strategy because it allows us to break the property down in components and really accelerate depreciation. Well, if I can get back my 100% bonus depreciation, I'm able to write off quite a bit of the acquisition of my real estate in the first year. So now I'm going to talk about, as I mentioned briefly earlier, that lovely depreciation recapture rule. So one of the things we have to remember is the government doesn't give us anything for free. It's almost the equality of scales. We have to remember that if we wrote something off and we got a tax benefit for it on this side, and all of a sudden we're going to get more money on this side because we sold something, we're going to have to make the scales equal. That's this depreciation recapture. because the government, the IRS, is allowing us to write off the rental property over so many years, when we go to sell it, we have to claim back that write-off they gave us, because depreciation is not used in the calculation of capital gains tax. And I'll talk a little further of how capital gains tax is calculated. So again, as I reiterate, depreciation recapture is taxed at your ordinary income tax rates. That's that lovely 10% all the way up to 37%. However, it is capped at 25%. So if you happen to be a taxpayer that's in the 37% tax bracket, your depreciation recapture will be taxed at 25%. If you're someone that's in the 22% tax bracket, your depreciation recapture will be taxed at 22%. So let's talk about different types of income. There's two types of income. There's passive income. And passive income is income from a business in which you don't really materially participate. The IRS rule basically says you did nothing to earn the income. Well, obviously we did something. So I really don't like that we didn't do anything to earn the income. But it's where you don't really materially participate. And rentals happens to be that passive income, because we're not doing the day-to-day managing of the rental income. And in other types of passive income is if you're a member of another partnership. You're not in there reviewing the financial statements or selling the product. So you're really not materially participating. This is considered passive income. The reason why this is so critical is that passive income, the losses are limited. We don't get to write off all the losses. It's capped at $25,000. And if our adjusted gross income exceeds $150,000, it starts chipping away that $25,000 loss. And eventually we're unable to even claim the loss. Does that mean the loss goes away? No. It carry forwards indefinitely until something changes. And those changes are either your income finally has gone down to below $150,000, so you might be able to qualify for some of that loss, or you've sold the property and you no longer have that property. Then all of those losses that you were unable to take on your tax return are now going to come forward, and you're going to be able to claim those losses against that gain. The next thing so the other part of the income, we have passive income. Now we're going to talk about non-passive income. And what's non-passive income? That's stuff that we materially participate. So that's usually our W-2s, our interest income, dividend income. If we're at that retirement age and we're taking distributions from our 401k or IRA, that's considered non-passive income. It just means if we had any losses in our non-passive income, and you would think, well, why am I going to have losses in my W-2? But let's say I have a sole proprietorship. I'm running a business that I'm materially participating in, and that business is showing a loss. That loss is not limited because I am materially participating. So therefore, that is also considered non-passive income. All right, so now we've talked a little bit about the overall aspect of real estate taxes. So what can you write off when you have a rental property? And so the items that you're able to write off are obviously your mortgage interest. Well, why this is critical is the fact that there is a rule in the tax code that says I can only write off interest income up to $750,000 of acquisition debt. So let's say I have a mortgage and I owe the mortgage $800,000. Well, I can't write off all the mortgage interest because it exceeded the $750,000 cap. I can write a percentage of it off, obviously taking the 750, dividing it by 800, it will give me a percentage, so I multiply that by the mortgage interest. That would be part of the mortgage interest. That only pertains to primary residences and your second home. When it comes to a rental property, an investment property, there is no cap. We are allowed to write off 100% of the mortgage interest that we paid on that home. Then it's real estate taxes. We're able to write off our real estate taxes. Again, it is unlimited. If it was our primary residence, it's actually capped at $10,000. We're only able to write off $10,000. And my West Coast clients, my East Coast clients, my Dallas-Fort Worth clients, we all know that our property taxes well exceed $10,000. But unfortunately, with where the current tax code is, we're only able to write off $10,000 when it's our primary residence or our second home. But when it's in regards to rental real estate, investment property, there is no cap. We're able to write off 100% of that cost. The other thing are operating expenses. That's the insurance of the rental property. That's the repairs and maintenance of the rental property. That's the HOA fees, landscaping, anything else, maybe utilities, stuff like that. Anything that's considered operating, anything that is used to maintain the property is deductible against your rental income received. There's also travel expenses. So if you have to drive back and forth from your home to your rental property just to check it out, keep track of those miles because those miles are deductible. Or if you have a rental property that's out of state, keep track of those flights, those meals, because those are all deductible against your rental income. Home office deduction. So if we're having a rental income or an investment piece of property, we're technically having a business. And to maintain our business, so balancing our checkbook when it comes to the rental income that we're receiving, paying our mortgage on that rental property, paying the property taxes, calling the plumber for the tenant if there's a leak. We're probably doing this in our home office. Well, you're entitled to write off or take a home office deduction against that rental income earned to help lower that taxable profit. And finally, with the new tax code that came into place, anything that's done energy efficient, maybe you put energy efficient windows, you can get up to a max of $600 for that. Or energy efficient doors, you can get up to a max of $500. Or let's talk solar panels. My goodness, we could put up solar panels, we can get a credit up to $30,000. So anything that we've done energy efficient wise helps generate a credit on our tax return and to lower our overall taxes. So now I've talked about owning a rental investment property, sort of the real estate taxes, the capital gains tax, all that kind of not so fun stuff, the things that we can kind of write off against it to help lower the profit. Now I want to talk to you about ways to save money on that property if you were to sell it. So one of the things that I want to talk to you about is the special allowance for being a real estate professional. Earlier, I spoke about passive and non-passive income and how passive income, the losses are limited if our income is over $150,000. Well, if you qualify for the real estate professional designation, those losses are not limited. You can write off the losses against your ordinary income. So if I had a rental property and I qualified to be a real estate professional and that loss was $30,000, it wouldn't be capped at the $25,000. I'd be able to write off that $30,000 loss completely against my income. So the qualifications to become a real estate professional is that 50% of your services must be performed in the production of a real estate business that you materially participate. What does that mean? Well, it means that you're spending your time either A, locating another real estate investment property, or you're driving to go visit your rental property, or you're renewing your leases on your rental property, or you're fighting the property taxes to lower your property taxes, or you're the one that's calling the plumber or dealing with the landscaper, etc. on that rental property. That would constitute that 50% of your time, okay, is spent in producing the real estate income or real estate properties. The other thing is that you have to deal with 750 hours of service in real property trades or business that you materially participate. So above is 50% that I have to materially participate, but you also must perform more than 750 hours of service. So it's easy for us to say that we materially participate in maintaining our rental property 50% of the time. Let's say you're a stay-at-home or you have a business that's out of your house. You can easily determine that you're spending 50% of your time trying to generate or maintain that investment property. Well, you also need to do 750 hours. What is the 750 hours? Again, it's looking for other real estate ventures. And it doesn't mean rental properties. It could actually be syndication deals. It could be REITs. It could be anything that has to do with building your real estate portfolio. Let's say you were looking for an Airbnb and you flew to Florida. That constitutes the 750 hours, that plane ride to go fly to Florida, the time spent to locate where an ideal Airbnb is going to be, the time that you spent looking at that property, that all comes into play in regards to making up those hours. The other thing is it says that you have to materially participate, and the IRS has this 7-test list on it. But if you meet the two that I talked about, 50% of your service is done in real estate, and that you spent 750 hours in it, then you've actually met the material participation rule. It's just a little bit of redundancy when it comes to that. Do you have to be a real estate professional, i.e. a realtor or a mortgage broker, to qualify for this? Nope. All you really need to do is meet those 3 criteria. 1, 50% of your service, 750 hours, and you must materially participate. This is huge. This is something that I think everyone really, if they're starting to get into real estate, they really want to see where their hours are going. I know it sounds like a very tedious process, but I recommend that you keep a journal or a notebook and you literally write down exactly what you did in your rental property. Even on, we all have iPhones. We got calendars on our iPhones. Just type, hey, I talked to the tenant today, 5 minutes. By the end of the year, you're going to be surprised how many hours you spent on maintaining that rental property. The other thing is cost segregation. This happens to be one of my favorite tax planning strategies. Now it falls into line about being a real estate professional, because if your losses are capped at $25,000 or you don't even get to claim them, then this is probably a mute strategy. But what cost segregation is, it actually takes the building and it breaks it down into its components. So for example, the IRS says that the framing of the building, just the framing of the building, has to be depreciated 27 and a half years. Okay? But my doors, my windows, my kitchen cabinets, my appliances, my floors, carpeting, all the other stuff that's inside our property, they're depreciated 5 years, 7 years, 15 years. And so if we can break our property down that way and we can get accelerated depreciation, and fingers crossed, they bring back the bonus depreciation of 100%, we can write off 100% of that, we have a substantial depreciation write-off. In my practice, when I've seen real estate investors do that, I have seen their depreciation expense be over $100,000. So could you imagine having a $100,000 loss, and because you qualify as a real estate professional, you can use that loss against your other income? That's a substantial savings. Now, do I recommend that every time? No, because it's a one and done. You can't do a cost segregation on the same property every year and get such a large depreciation. And you have to be careful because now I wrote off $100,000 of depreciation. If I were to sell that property, I'm going to have to recapture it, and I'm going to have to pay up to 25% tax on it. But if I know that I'm coming into a big income year, let's say my partner has stock options, and all of a sudden, all of his stock options are going to vest that year, and the W-2 is going to go from $500,000 to over $1 million. And I know now I'm in the 37% tax bracket. My goodness, what can I do? Oh, I have this rental property. Maybe doing a cost seg would be a good idea right now because we already qualify as the real estate professional. What would that look like against my husband's W-2 to see whether we can lower the tax bracket and get us back down to 35%? That, a 2% savings is dramatic at that time. And then you can deal with later if you decide to sell that home, because there's other strategies that I'm going to talk about next on that. But cost segregation happens to be a great strategy. And it doesn't necessarily have to be on a rental property. I've sometimes advised clients when they have extra cash flow, just for this example of stock options all of a sudden hitting a W-2, is to go out and look for a building that maybe is hosting a commercial industry, the Starbucks, Jiffy Lube, something like that, and do a cost seg on that building. You've got income that's coming in, and now you have a higher valued property that you can take a much larger depreciation recapture on and save more money, and you just built up your investment portfolio. The other strategy that's out there, and it's very common, it's called a 1031 exchange. And what is a 1031 exchange? It allows you to defer capital gains taxes on the sale of the property. The rules is that the exchange has to be like kind. What does that mean? If I have a rental property, I need to exchange it for another rental property. My replacement value has to be equal or of greater value. Let's say my rental property is worth $1 million. I can't go and find a rental property for $500,000 because that's not equal or greater value. I could go and do a 1031 exchange on multiple rental properties to get it to the value of what I'm replacing. There is absolutely no limit on how many 1031 exchanges that you can do. You can do multiple 1031 exchanges in a year, and you can constantly be doing 1031 exchanges every year. There are some really specific rules, though, that you need to follow. And if you miss one of those rules, you don't qualify for a 1031 exchange, and your property or your sale would be subject to capital gains tax. One of that is that after selling your property, you have 45 days to find a potential replacement. And in today's market, yes, that can be quite difficult, but you have 45 days to find a replacement property. Once you've found that replacement property, you need to hire a 1031 exchange intermediary company. You can't take hold of those funds. They need to be listed on title, on settlement, that when the property sells, the gain or the money that you're receiving from that sale property goes into their escrow, and they then have 180 days from that point to close on the property that you located. So to summarize, let's say I sold my property. The cash that I made on it is $250,000. I've located another property in my 45-day limit. I hired an intermediary company. When I sign my closing papers, the $45,000 never touches me. It actually in escrow gets paid to this intermediary company. They hold my funds. So when my other property closes within the 180 days, my replacement property, it will be paid out of that escrow fund to the new property. The minute I take any money, so does that mean the full amount of my money that I made on my property has to go in the 1031 exchange? No. But just know that any cash, anything you touch, and by touching I mean it hits your bank account, you're going to pay capital gains tax on that. The one thing that definitely changed in the tax law in 2017, I believe, tax law is that we can no longer do a 1031 exchange of a business. We can only 1031 exchange investment real estate. We can't 1031 exchange our primary residence, and we can't 1031 exchange our vehicles anymore. I get asked that a lot when my clients come in. They say, oh, I sold my business car and I bought a new one. Great, we're going to have to pay capital gains tax on the sale of the first car because we can no longer do a 1031 exchange on vehicles. It is only investment real estate. The other thing is that I can invest in opportunity zones. So what are opportunity zones? Opportunity zones are usually areas that need to be revitalized. And so I can defer my taxes on my capital gains by putting them into an opportunity zone fund. It's actually a partnership that I control, a checkbook that I maintain. I put the money in that opportunity zone fund, and I don't have to pay taxes on the sale. And that doesn't pertain just to real estate. It could be stock. Let's say I was one of the lucky people that I ended up buying into Tesla stock when it was worth hardly anything. And now I'm ready to sell my stock and I'm looking at sizable gain. Well, I can take that gain and put it into an opportunity zone fund and not pay any capital gains tax on that money. And if I hold my opportunity zone, so the property that I have then in turn built up, revitalized in this opportunity zone area, and mind you, it doesn't have to be property, it can be a business. If I hold that money in there for 10 years or more, I don't pay any taxable gains on the increase of what is being made. That's sizable. I just deferred my capital gains tax down the road, and I don't have to pay gain on the profit that is made if I sell that opportunity zone. And I don't have to pay tax on the recapture of my depreciation. That's eliminated. The other thing is tax loss harvesting. This is kind of a neat way of doing it. As I mentioned, rental real estate is passive losses. And if I have all these passive losses, for example, or if I sell my real estate and I have a sizable gain on it. So let's say I have a profit of $300,000 I'm going to report on my taxes. But I've got stock and the stock isn't producing anymore. And if I sell it, I'm going to realize some losses. I'm still pocketing some cash, but I'm going to realize some losses. I can take those losses and offset the gain of the sale of my property. That's what tax loss harvesting is. It's not a lot. We can't really sell $300,000 worth of losses in our portfolio, because if you had $300,000 of losses in your portfolio, I would be questioning my financial planner. But if I had losses in there of stock that isn't doing well, and I sold a piece of property and I'm looking at gain, this would be actually the year that I probably would want to sell them, because I could write them all off against that gain. Normally, if I sell stock at a loss and it exceeds $3,000, I can only write off $3,000. So if I have a gain that I can write off all these losses against, now the time is to utilize that. So I know I talked about a lot and all these different things. I'm gonna take you through a couple case studies that are on the slide. And the first case study is the sale of a property. So it's the estate wizards. They owned a rental property long term. They originally bought the property for about $300,000. They sold it for $680,000. They claimed around $43,000 in depreciation. Their closing costs on the property were about $74,800, and they're in a $15,000 capital gains bracket. In this scenario, the estate wizards would owe about almost $46,000 in capital gains, because you take the $680,000 less the $300,000 less the $74,000 in closing costs, and you multiply that by 15%. This is just high level. There's obviously other things that come into play. And they would also owe almost $11,000 on that depreciation recapture, because they got a write-off of $43,000 in depreciation over the lifetime of owning this rental property. They take that number and they multiply it by the cap of 25%. They owe an additional $10,000. So in total, on the sale of this one rental property, Estate Wizards is going to almost owe $57,000 in taxes. But let's say they decide to do a 1031 exchange. So in the case study number 2, what ends up happening is they get to roll all of that gain, all of that almost $57,000 in tax. They get to roll that over into their new investment property and pay 0 tax in the time of the 1031 exchange. And they can keep doing this. And you know, the beauty of this is if they continue to do this and hold the property, and God forbid they pass away, their beneficiaries will not have to recapture any of the depreciation and most likely not pay any capital gains because they get something called a stepped up basis. So do I recommend 1031 exchanges all the time? No. Tax planning is something that is an ongoing process, and it's tailored to your specific financial situation and goals. So it's imperative that you work with a qualified tax professional to make the proper decisions that will benefit you in the long run. You can't just go in and say, I'm going to do this year. You need to find out what it looks like this year and what it's going to look like 5 years from now. What is your long-term goal? Is real estate investment going to be your retirement plan? Well, let's talk about this, because the last thing we want to do is start selling our property and paying all this capital gains tax now, and then you're not going to have that investment come later. Or as some of my clients do, they say, oh, I better sell a property because I'm short on cash. Oh, Lord, wait, because in my retirement age, when I sell something and my income bracket is going up, guess what I just affect? I ended up hurting my Medicare. And now I'm going to have more Medicare deducted out of my Social Security benefits. So was it a wise decision to sell that property because I needed more cash? Because now I'm going to end up getting less Social Security benefits and half of my money went and paid capital gains tax? Maybe not. Maybe there's other strategies that you can do. So I highly recommend that you go and have a regular tax planning strategy with a tax professional so that you're making informed decisions and saving money on your taxes. And so with that, I'd like to end this podcast. I hope this was very valuable information. Please, if you have any other questions, reach out to us at Decision Financial. You can reach out to us at contact@decisionfinancial.com. I know I put a lot of information into this podcast. Usually this is broken out in components. So please, if you have any questions on what was discussed, reach out, or if you want me to expand on anything in the next podcast, I will gladly do that. All right. Well, thank you all for listening and have a great day.